Now, QuickBooks Online and other software like that assume that you don't know anything about accounting, and it's really set up so that you don't have to have an accounting degree to use it. And that's great, except for one problem. If you don't have a basic understanding of accounting and how it works, and you try to set things up in QuickBooks Online, you can get yourself into problems if you don't have the basic understanding. But fortunately, you don't need to go get an accounting degree. You don't need to take a college accounting class to understand this, because I'm going to give you the information that you need. I'm going to give you the need to know accounting rather than all of the accounting. So the first thing that you need to know about accounting is the whole purpose for doing this stuff. And the whole purpose for doing this stuff, all these transactions and keeping track of everything, is to create financial statements. And financial statements are like a chart if you're in the hospital. The doctor and the nurse come in and they look at your chart and they say, okay, I can see how things are going here. Your fever is going up, your fever is going down, your blood pressure is rising, what's going on here? So financial statements tell you about the health of your business. Is it improving? Is it getting worse? What's going on with your business? And that's exactly why we do all of this accounting stuff. It's to create those financial statements that are going to show you what's going on in your business and help you to run it better and more profitably. So the two financial statements that most people are going to be familiar with, if they're familiar with a financial statement, would be the income statement, which is also called the profit and loss statement or the P&L, and the balance sheet. And these are two really important financial statements because they tell us great things about what's going on in our business. Now, there's a couple of other financial statements that you're going to run into. One of them is called a statement of owner's equity or a statement of retained earnings or a statement of stockholders' equity. The name varies based on the type of ownership of the company. That in QuickBooks happens behind the scenes. We talk about it in financial accounting classes, but we don't really see much of it going on in QuickBooks because it's going on behind the scenes. The other one that you'll run into is called the statement of cash flows. And statement of cash flows is all about the cash account, how cash moves through the business. But when we set up QuickBooks Online, the way that we set it up is going to determine where things go on those financial statements. So a balance sheet is going to show certain accounts, and the income statement or profit and loss is going to show other accounts, and it's going to give us a picture of what's going on in the business. It's actually going to give us two different pictures of what's going on in the business. So for a more in-depth look at financial statements, I'll drop that video below so you can check that out. The second piece of need-to-know accounting is something called the accounting equation. The accounting equation is so important that I actually have it, I don't know if you can see this, I actually have it on my t-shirt because that's how I roll. So the accounting equation is assets equal liabilities plus equity. So what this shows us is what the business owns, assets, versus what the business owes, liabilities, and the difference between the two is equity. So the accounting equation is the basis of all accounting. And everything that we do in business, we buy stuff, we sell stuff, we invest money, we take money out, that all happens within the context of that little equation, like assets equal liabilities plus equity. So that's what's going on behind the scenes with QuickBooks. You're increasing and decreasing things, and it's impacting that accounting equation. So for more about the accounting equation, I'm going to drop a couple of videos down below so you can dig into that deeper. The next need to know accounting is something called account types. So those account types relate back to both the financial statements and to the accounting equation. So we talk about those types of accounts as being 5 major accounts. We have assets, we have liabilities, equity, revenue, and expenses. Now, the balance sheet is all about assets, liabilities, and equity, and the income statement or profit and loss is about revenue and expenses. So 5 different accounts, and they get split up into those 2 different financial statements. So assets are something that a company owns, And we have a cash account, we have a building, we have a vehicle. Those are all examples of assets. On the other side of the accounting equation, we have liabilities, equity, revenue, and expenses. So liabilities is what a company owes to vendors or banks, and equity is what a company owes to its owner. So that's an important distinction. Equity is what a business owes to its owner. And a lot of times when we're working with small businesses or we own a small business, we see the business as being us, right? But the business is separate from us. The business owes us money. We've invested into it and it owes us money back. So when we're talking about equity, equity increases and decreases. So for example, if an owner puts money into a business, makes a cash investment, for example, I'm going to put $50,000 into this business, then I have equity. It increases my equity. If I take money back out, owner's draw or dividends, then I decrease my equity. With me so far? Because now we're going to bring in revenue and expenses. So let's think about revenue as something that increases the value of my equity in the company. Because when you think about that, if you have a business that is making revenue, it's selling stuff, that is more valuable than a business that isn't making money, isn't selling stuff, right? So we can say that revenue increases an owner's equity. Now, when we're talking about expenses, expenses decrease equity. So if you had a business that was all revenue and no expenses, that would be a great business, right? But usually it takes money to make money. So when you spend part of that money that you're making, your revenue, you're spending part of that on expenses, it decreases equity. So that equity piece of it in the accounting equation is all about increases and decreases in the value of the owner's share of the business. So when we're talking about regular old accounting, like old school accounting, we have those 5 types of accounts. We've got assets, liabilities, equity, revenue, and expenses. When we're talking about accounting software, we're going to add some account types to those, more like sub-account types. Because in QuickBooks, when we assign an account type, it's telling QuickBooks some specific information. So let's talk about one asset called cash. Now in QuickBooks, you may call your cash account something like your bank name checking or your bank name savings. It's a cash account, and a cash account is an asset. But in QuickBooks, we're going to have a special kind of asset account, and it's going to be called banking. And when you assign an account type called banking, it tells QuickBooks that you need to do some specific things with that account. You need to be able to access your bank feeds, or you're going to hook up to your bank to have your transactions downloaded. You're going to need to reconcile that account. So when you assign it that specific account type, then QuickBooks is going to say, oh, okay, this is a bank account and I need to do certain things with that. If we're talking about an account called accounts receivable, you are invoicing your customers and they're going to pay you later, then we assign that not as an asset as we would in manual old school accounting. We're going to assign that an account type called accounts receivable, and that's going to tell QuickBooks that you have some specific things that you need to do with that. You need to do invoicing, and you need to receive payments from customers, and you need to be able to run certain reports. So QuickBooks has the 5 account types, but they've expanded them to be specific things that will make accessing certain modules of the software available. Now, when we're talking about account types, there's something that goes along with those account types called a normal balance. And a normal balance says we expect that this account type is going to have a normal debit or credit balance. Now, debits and credits can be very confusing for people, but here's the simple, honest truth about debits and credits and what it means. Debit means left and credit means right. That's it. Don't get it confused with debit cards and credit cards and all those kinds of things. Debit is left, credit is right. Now with QuickBooks, You're not going to be doing much with debiting and crediting things because the software is going to magically do it for you. But there are going to be times when you need to do a journal entry. For example, if you need to record depreciation expense, you're going to do that as a journal entry. Most things are going to be done as an entry, like entering a bill from a vendor or creating an invoice for a customer. But behind the scenes, there is accounting going on. And if you have a basic understanding of what that is, it helps to make things a lot easier, because when QuickBooks asks you a question, do you want to do this, or would you like to do that, you have some confidence that you are giving it the right answer, because otherwise you're sort of guessing and hoping you got it right. Now, I'm not going to go too deep into normal balances and rules of debit and credit in this video, but I will put some videos down below so that you can check those out. And this all brings me to the biggest need to know, besides financial statements, for working with QuickBooks Online, and that is the chart of accounts. The chart of accounts is a listing of all of the accounts that you're going to be using to categorize your transactions in QuickBooks. And based on that chart of accounts, that's all going to feed accounts into your financial statements. So it's important that you understand how to set that up and how things that you do within the chart of accounts can make your life a lot easier or a lot harder. So I'll link my chart of accounts video down below so that you can explore that in more detail. But when we go into the QuickBooks Online software, which we're going to do next, I'm going to walk you through the chart of accounts in QuickBooks. And then when we get to the point where we're setting up a brand new company, I'm going to show you how to really manage that chart of accounts bit so that you have something that is very workable, it's simple, it's straightforward, there's not a lot of fluff and falderall in it. So go ahead and check out those other need-to-know accounting videos that I've posted down below. And then we're going to jump into the software and start to navigate our way through this so you can start to feel confident about knowing where things are and how they work. And I will see you in the next video.